If you own gold, or even a retirement account with gold exposure, this might feel like a punch in the stomach. In just one brutal week, gold took a hit so sharp that many investors did not even have time to process it before more selling came in. And here is the part that makes it even stranger. This happened while the world was watching missiles, oil fears, and rising tension in the Middle East. The one moment when gold is supposed to look strong, and instead, it dropped. That is the story nobody can ignore, because this is not just about one ugly week on a chart. This is about how money really moves when fear hits the system. It is about why the asset many people call safe can suddenly feel very unsafe. And it is about the mistake that regular investors keep making when markets get loud, emotional, and chaotic. Most people still think gold follows a simple rule: bad news up, war up, fear up, gold up. Clean, easy. Nice little textbook answer. The problem is, markets do not care about textbook answers. Markets care about pressure. Markets care about forced selling. Markets care about who needs cash right now, not who has the best story. And that is where this gets dangerous. Because if you do not understand why gold is falling during a global crisis, you can make the worst possible decision next. You can sell at the exact wrong time. Or even worse, you can double down in the wrong product and turn a normal drop into a personal disaster. Pause there for a second. That is the real issue, not the price itself. The reaction. When people see gold falling during war, they start asking the wrong question. They ask, is gold broken? But the better question is, what is forcing the selling? Because once you understand that, the whole picture changes. And the picture right now is bigger than gold. This is about oil. This is about inflation. This is about interest rates. This is about the dollar. This is about machines trading at lightning speed. And yes, it is also about the difference between paper markets and the real world. Sounds boring? Give me 1 minute. If oil supply gets hit, prices go up. When oil prices go up, almost everything gets more expensive. Fuel, shipping, food, fertilizer, plastic, medicine, factory costs, airline costs, daily life. Oil touches everything. So the moment a major energy route gets disrupted, inflation risk wakes right back up. And that matters because central banks hate inflation almost as much as investors hate losing money. So when markets start to fear fresh inflation, they stop expecting easy money. They stop dreaming about big rate cuts. In fact, some traders start thinking rates may stay higher for longer. Some even start thinking rates could go up again. And that changes the game. Why? Because gold does not pay interest. A treasury bond does. Cash does. Short-term government paper does. So when interest rates stay high or bond yields move higher, gold suddenly has competition. Real competition, not theory. Actual dollars chasing safer income. Here comes the weird part. War can be good for gold in one way and bad for gold in another way at the exact same time. The fear side says buy gold. The inflation side says rates may stay high. The high rate side strengthens the dollar. The strong dollar side pressures gold. And the machines? They often follow the second chain, not the first one. Welcome to modern markets, where robots have no fear and margin calls have no patience. So while regular people look at the headlines and think, this is bullish for gold, giant systems are reading bond yields, dollar strength, volatility spikes, and technical levels. And once certain lines break, massive selling can begin automatically. Not because somebody made a speech, not because somebody changed their mind, because code did what code was built to do. That is why the move feels so cold. No drama, no emotion, just pressure. And when that pressure starts, it often feeds on itself. Lower price leads to more selling. More selling leads to more fear. More fear leads to bad decisions. Bad decisions lead to more lower price. It becomes a spiral. And that spiral is exactly why this move matters so much. Because gold did not just drift lower. It broke confidence. It shocked people. It broke the simple story many investors hold in their heads. And when a market breaks the story, people panic faster than they panic over the chart. Let me say that again. The chart hurts, but the broken story hurts more. If people believe gold protects them in chaos, and then chaos arrives and gold falls, they do not just lose money. They lose trust. And once trust goes, selling gets much easier. That is one reason these drops can get ugly fast. Another reason is leverage. And we are going there in a second, because that is where many retail investors get trapped. They do not just buy gold. They buy the turbo version, the doubled version, the I want gains faster version, which sounds great when price goes up, until it goes down and the math turns into a horror movie. But before we get there, lock in the core idea. Gold is not falling because fear disappeared. Gold is falling because another force became stronger in the short term. That force is the market pricing in inflation pressure, higher for longer rates, a stronger dollar, and a wave of forced selling across paper products. This is why people get blindsided. They think gold is trading on one story when it is actually trading on 4 stories at once. And that is the heart of this entire video. So, no, this is not random. No, this is not proof that gold is useless. And no, it does not mean every old rule is dead forever. It means this market is being pushed by pressure points most people never watch. And once you see those pressure points, the move stops looking crazy. It starts looking mechanical, which is good news, by the way. Because a scary move is hard to handle. A mechanical move is easier to study. And what can be studied can be survived. So in this video, we are going to break this down the simple way. First, we will look at how leverage turns a drop into a collapse. Second, we will look at how algorithms and paper markets can crush price even when real-world demand stays strong. Third, we will look at the historical pattern that may explain who could be selling into this mess and why. Then, we will talk about the real solution. Not hype, not panic, not buy the dip slogans from people who never show their losses. A real framework. The kind of framework that helps you think clearly when everybody else is shouting. Because right now, the goal is not to sound smart. The goal is to avoid being stupid with your money. And in markets, those two things are very different. Let's start with the first example, because this is where a lot of the damage gets done. Leverage. This is the part many investors love in good times and hate in bad times. A leveraged gold product promises more upside when gold rises. 2 times the move, 3 times the move. You start doing the math in your head, and suddenly you feel like a genius before you even make money. Gold goes up 2%. You go up 4 or 6%. You tell yourself, this is easy. That sentence has ruined more portfolios than recessions. Because leverage feels smart when the market agrees with you. But when the market turns, leverage stops being your friend and starts acting like a trapdoor. Here is why. These products usually rebalance. That means they have to adjust positions as prices move. So when gold falls, these products may be forced to sell more to maintain their structure. Then that extra selling pushes price down further. Then more rebalancing hits. Then more margin stress hits. Then more people rush for the exit. It is not just my investment went down. It becomes the product itself adds more fuel to the fire. And that is how a normal correction can turn into a violent breakdown. A joke, but not really. Leverage is like giving espresso to a market that already has anxiety. This is one of the biggest reasons retail investors get hit harder than they expect. They think they own gold. In reality, they own a product linked to gold that behaves in a much more fragile way under pressure. Big difference. Very big difference. When price rises, most people do not ask how the machine works. When price falls, suddenly the machine matters. And if enough investors are crowded into these products after a strong rally, the unwind can be brutal. Not because the long-term idea changed overnight, but because the short-term structure was weak from the start. That is example number 1. Now let's move to example number 2, because this one is even stranger. The difference between paper gold and physical gold. Most people hear gold price and assume there is one gold market. There is not. There are linked markets, but they do not always behave the same way in moments of stress. Paper gold is things like futures, options, financial contracts, synthetic exposure, and certain funds that trade price movements more than metal itself. Physical gold is actual metal changing hands, stored, moved, bought, held. And when panic hits, the paper side can get crushed much faster than the physical side. Why? Because paper trades are often leveraged, faster, more emotional, and more connected to machine-driven selling. They can be dumped in huge size with the click of a button. Physical buying is slower, stickier, and often done by people or institutions with a different mindset. That split matters. Because while paper markets can scream, "Gold is dead," physical buyers may be saying, "Gold is cheaper now, give me more." Same asset, different behavior, different players, different time frame. And this is where many small investors get confused. They see a falling chart and assume demand vanished. But falling paper price does not always mean real demand vanished. Sometimes it means the fast money crowd is liquidating while patient buyers quietly step in. That is not always bullish right away. Let's be honest. A market can stay weak for longer than people expect, but it does change how you read the move. You stop asking, "Why is nobody buying?" and you start asking, "Who is being forced to sell?" That question is gold, no pun intended. Because if the selling is forced, emotional, or structural, then it tells you something different from a clean, informed, long-term exit by strong hands. And the paper market is exactly where those forced moves often show up first. Now let's add the machine layer. Because this is no longer a market driven only by human opinions. A huge amount of trading today is rule-based. Algorithms scan price, yields, volatility, trend strength, correlation, support breaks, and macro signals. They do not care that a TV host said gold should rise in war. They care what the inputs say. If yields are rising, if the dollar is rising, if gold breaks key levels, the machines may sell. Not maybe emotionally, just maybe automatically. No debate, no hand-wringing, no staring at the ceiling at 2 a.m., just sell. And once enough of those systems line up on the same side, the move can look way bigger than the headline story suggests. That is why people say, "This makes no sense." But it does make sense if you understand the players. Humans want a story. Machines want a signal. And in a short-term market panic, the signal often wins. So now we have 2 big pressure points. 1, leveraged products can force more selling as price drops. 2, paper markets and algorithms can push price much lower than the public expects, even while physical interest may still be there under the surface. This is why watching only headlines is dangerous. Headlines tell you what happened, structure tells you why it happened, and in money, the why pays better. Let me make this even simpler. Imagine a theater with one tiny exit. Some people are calm, some people are scared, some people borrowed money to buy tickets, some people are robots following flashing lights. Now imagine somebody yells, "Fire." That is a paper market sell-off. Not everybody wants out for the same reason, but everybody tries to move at once, and the price becomes the floor under your feet. This is also why people who brag during rallies often disappear during drops. On the way up, everyone sounds like a genius. On the way down, we learn who understood risk and who just enjoyed green candles. Hard truth. Useful truth. So if you are wondering why this gold drop felt so violent, do not just blame the news. Blame the structure. Blame the leverage. Blame the crowding. Blame the machines. Blame the fact that modern markets are built to move faster than human emotions can process. And if that sounds unfair, it is. But markets are not a fairness machine. They are a transfer machine. Money moves from the unprepared to the prepared every single cycle. Which brings us to the third example, the historical one. The one that may explain why this sell-off is not only about traders, but also about countries, cash pressure, and a very old pattern returning in a new form. Because sometimes the biggest seller in the market is not scared. It is simply hungry for dollars. Now for the third example, and this is where the story gets really interesting. History may not repeat exactly, but it loves to rhyme when money gets tight. There was another moment, decades ago, when gold suffered a brutal weekly fall. Back then, the setup looked different on the surface. The world was not dealing with the exact same headlines. The players were not trading with the same technology. The financial products were simpler, but the core issue was familiar: pressure for cash. And cash pressure changes behavior fast. In the old version of the story, oil-producing countries were under stress because energy markets had shifted. Supply conditions changed. Revenue pressure hit. Governments still had bills to pay, currencies to support, systems to keep stable. So what happens when a state needs cash and easy revenue is not flowing the same way? It sells what it can. This is the part many people miss when they think about gold. Gold is not just a fear asset. It is also a reserve asset. And reserve assets can be sold. That sounds obvious, but in a panic, people forget it. They treat gold like it is only a one-way safe haven. It is not. It can also become a source of liquidity when governments, institutions, or large players need dollars quickly. Now bring that idea into a modern crisis. If a major oil route gets disrupted, oil prices may jump. On paper, that sounds good for oil exporters. People imagine these countries swimming in money. But what if the problem is not just price? What if the problem is movement? What if high prices exist, but the flow of oil is impaired, delayed, attacked, or physically constrained? Then you have a strange problem. The commodity is expensive, but the cash flow is unstable. That is a terrible mix for governments built on predictable energy revenue. They still need to defend currency systems. They still need to support banking stability. They still need to fund budgets, projects, imports, and security. They still need dollars. And if the normal dollar machine slows down, they may look at reserves. That does not mean we know every sale, every seller, or every exact number in real time. Let's stay honest. But the pattern is consistent with what history has shown before. When revenue stress rises and reserve assets exist, selling can happen. This matters because it adds another layer to the gold drop. Now it is not only about leveraged retail and not only about machines. Now it may also be about large, serious sellers with practical reasons to raise cash. And markets do not ask whether the reason is noble. They just react to size. That is why I keep coming back to one idea. Gold is not failing in a simple way. It is getting hit by multiple waves at once. Wave 1, inflation fear returns through oil. Wave 2, markets expect tighter money for longer. Wave 3, yields and the dollar rise. Wave 4, algorithms sell. Wave 5, leveraged products unwind. Wave 6, large reserve holders may need liquidity. That is not one small problem. That is a full pressure system. And once you see it like that, the move becomes less shocking. Still painful, but less shocking. So what is the solution? Not a prediction, a process. That is the word regular investors need more often, process. Because the average investor spends too much time asking, where will gold be next week? And not enough time asking, what conditions make gold stronger or weaker? You do not need a crystal ball. You need a dashboard. For gold, two of the biggest things on that dashboard are the dollar and bond yields. Simple version. When the dollar is strong, gold often struggles. When bond yields are high, gold often struggles. Not always every day, not in a perfect straight line. But as a broad pressure map, those are huge factors. Why? Because a stronger dollar makes gold more expensive globally, and higher yields give investors a more attractive alternative. Again, gold does not pay interest. A government bond does. So when investors can earn more in safer income, some money leaves gold. This is why smart positioning matters more than loud opinions. It is easy to shout gold to the moon during a rally. It is harder to say, let me check the dollar, yields, leverage, and the type of product I own. But that second person usually sleeps better. So here is the first part of the solution. Stop treating all gold exposure as the same. Owning physical metal is different from owning an unleveraged fund. Owning an unleveraged fund is different from owning a 2 times or 3 times trading product. A long-term store of value position is different from a fast trade. These are not little details. These are the whole game. A lot of investors lose money not because their big idea was completely wrong, but because their vehicle was wrong. They had a long-term view and used a short-term weapon. Bad match. Like bringing a race car onto an icy mountain road and wondering why it spins out. The second part of the solution is time horizon. If you need the money next week, gold volatility can feel unbearable. If your time frame is longer and your position size is sane, the same drop may look very different. Still unpleasant, but not life-changing. This is why risk management sounds boring and saves real lives. Small joke. Nobody wants to hear about position sizing at the top. Everybody wants to hear about position sizing at the bottom. But that is how it works. The third part of the solution is emotional discipline. When gold crashes during a war, your brain screams, "This makes no sense. Get out or go all in." Both are dangerous impulses. Big emotional decisions made in high volatility moments are usually expensive. Better questions are these. Am I being forced to act, or am I choosing to act? Do I own the right product for my goal? Am I reacting to headlines or watching the real pressure points? Has the long-term case changed, or is this a short-term liquidation event? Those are adult questions. Those are investor questions. And in markets, being adult is an edge. Because panic is loud, process is quiet. Now let's bring this home. What should a smart investor actually do when gold gets crushed in a moment like this? First, separate story from structure. The story says gold should rise in chaos. The structure says gold can fall if inflation fear pushes yields up, the dollar up, and forced selling through the system. Both can be true at once. That is why this move confused so many people. They were watching the story. The market was trading the structure. Second, know what you own. If you own leverage, understand the danger. Those products can turn a rough week into a total mess. They are built for short-term trading, not for emotional comfort, not for deep sleep, and definitely not for people who think, I will just hold and hope. Hope is not a strategy. It is a delay button. If your goal is long-term exposure, keep it simple. Physical metal, carefully chosen plain funds, balanced positions, patience. Nothing sexy there, but boring often wins in money. Third, watch the real signals. Watch the dollar. Watch bond yields. Watch central bank tone. Watch whether this is becoming a broad liquidity event or staying a gold-specific sell-off. Watch whether physical demand stays firm while paper markets wobble. Because that split matters a lot. If paper price gets smashed while strong hands keep absorbing physical supply, that tells a different story than a world where everybody is dumping everything. It does not promise an instant reversal, but it changes the odds over time. Fourth, respect the possibility that this is not a one-week drama. This part is important. Markets do not always snap back just because something feels oversold. Sometimes a crash is the start of a reset, not the end of one. Sometimes a market needs time to rebuild trust, clear weak hands, and find stronger ownership. That means patience may matter more than bravery. A lot of investors confuse courage with speed. They are not the same. You do not need to be first. You need to be right enough and sized properly. That is a much calmer game. And yes, let's address the big emotional question. Does this mean gold is dead? No. A hard drop does not erase the long-term reasons people own gold. It does not erase debt concerns, currency concerns, geopolitical risk, central bank buying patterns, reserve diversification, or the simple fact that many institutions still view gold as insurance. But insurance can have ugly pricing periods. That is part of reality. And if you entered with leverage, poor timing, weak understanding, or money you needed quickly, that reality can feel very personal. So the lesson is not never own gold. The lesson is own it the right way, for the right reason, in the right size. That sentence can save a lot of pain. Now let's recap the big picture in plain English. Gold got hit hard, not because fear disappeared, but because a stronger short-term chain took over. War pressure pushed oil fears higher. Oil fears pushed inflation fears higher. Inflation fears pushed rate expectations higher. Higher rates and higher yields supported the dollar. A stronger dollar and higher yields pressured gold. Then algorithms sold. Then leveraged products were forced to rebalance. Then panic spread. And on top of that, large reserve holders may have had reasons to raise cash. That is the machine behind the move. Not magic, not betrayal, not the end of the world. A machine. And once you understand the machine, you stop acting like a victim of every candle. You start acting like an investor. That is the shift that matters most. Because the real winners in markets are not the people who never see volatility. They are the people who understand what kind of volatility they are looking at. There is a huge difference between a broken thesis and a forced liquidation. A huge difference between nobody wants this asset and too many weak hands own this asset the wrong way. A huge difference between fear and pressure. So if you take one thing from this video, let it be this. Do not let one violent week make your whole strategy for you. Study the reason. Study the structure. Study the players. Then decide. Not before. And definitely not because somebody on television said one line with dramatic music behind it. Please. Your portfolio deserves better than soundtrack-based investing. For Sandra, this is the message I want to leave you with. Gold may still matter, but understanding market mechanics matters more, because in finance, the asset is only half the story. The other half is who owns it, how they own it, and what forces can push them out. That is where the real edge lives. If you enjoyed this breakdown, subscribe to the channel, hit like, and stay close, because we are going to keep turning complex money stories into simple, useful lessons you can actually use. And now I want to hear from you. Do you think this gold crash is a long-term warning sign, or just a short-term shakeout before the next move higher?